Most people never figure out that the way you should be investing at 25 looks completely different from how you should invest at 45. And copying the wrong strategy at the wrong age could cost you hundreds of thousands of dollars or more. In this video, we're going to walk through exactly what your portfolio should look like in your 20s, 30s, 40s, 50s, and 60s, and with specific numbers, specific ETFs, and a clear strategy for every decade. Risk profiles explained. Before we get into the decades, you need to understand your risk profile, because not everyone invests the same way, even at the same age. There are three types of investors: the aggressive investor, who is comfortable with short-term losses in exchange for bigger long-term gains; the moderate investor, who wants growth but with some cushion; and the conservative investor, who prioritizes not losing money over maximizing returns. We'll cover all three in every decade. Figure out which one you are, because that shapes everything. Why stocks beat bonds long term? Stocks have outperformed bonds for over 100 years. If you invested $10,000 in the S&P 500 in 2012, you'd have had around $32,000 10 years later. The best bond fund over the same period? About 15,000. Stocks win, but with a catch. In any given year, there's roughly a 31% chance the market goes negative. That's almost 1 in 3 years. And in bad years, we're talking drops of 30% or more. This is why your age matters so much. The younger you are, the more time you have to recover from those down years. Your 20s, go aggressive. Your 20s are the most powerful decade for building wealth. Not because you're earning the most, but because time is on your side. If the market drops 60% right now, it doesn't matter. You have 35 to 40 years for it to recover and keep growing. This is the one time in your life where being aggressive is almost always the right call. The goal in your 20s isn't just to invest, it's to build the habit. Even $25 or $50 a week makes a difference, because starting at 20 versus starting at 30 can be the difference of hundreds of thousands of dollars by retirement. Here's what the portfolios look like. Aggressive, 100% stocks, 0 bonds. Moderate, 90% stocks, 10% bonds. Conservative, 80% stocks, 20% of bonds. And for stocks, keep it simple. VOO or VTI for US exposure. Add VXUS if you want international. That's it. You don't need anything else at this stage. And here's something counterintuitive. If you're in your 20s, you actually want the market to crash, because that means you're buying everything at a discount. The people who build real wealth are the ones buying consistently while everyone else panics. Your 30s survive the messy middle. Welcome to what some people call the messy middle. In your 30s, life gets complicated fast. Mortgages, kids, a spouse, more bills than you ever expected. Your income is growing, but so are your expenses. The temptation is to pull back on investing when money feels tight. Don't. Your 30s and 40s are your prime earning years, and missing contributions now will cost you later. The good news is your risk tolerance doesn't need to change much from your 20s. You still have 25 to 30 years until retirement. The key move in your 30s is automation. Set up automatic contributions to your 401k and Roth IRA so the money comes out before you can spend it. You're not fighting willpower, you're removing the decision entirely. Portfolio-wise, aggressive investors stay at 90 to 100% of stocks. Moderate drops to 85% of stocks. 15% bonds. Conservative goes 70% stocks, 30% bonds. As you move through the decade, you can gradually shift allocations. That's totally fine. The core message is stay invested and stay consistent. Your 40s, peak earning, protect the snowball. Your 40s are typically your highest earning years. And if you've been consistent, your portfolio is starting to do something exciting. With $1 million invested at 10%, the market is generating more money in a single year than you're adding yourself. That's compound interest doing the heavy lifting. But here's where people make a critical mistake. They get greedy. They start chasing high-risk individual stocks or hype plays. Do not do this. When you have $500,000, $800,000, $1 million saved, this is not the time to gamble. You've spent years building this. Keep the momentum going. Start introducing more stability into your portfolio. Aggressive, 85% stocks, 15% bonds. Moderate, 75% stocks, 25% bonds. Conservative, 60% stocks, 40% bonds. If you want to add bonds, the cleanest way is to redirect new contributions into a bond ETF like BND or AGG. Let the stock position slowly get diluted over time without having to sell anything. And when you get a raise, increase your 401k contribution before you touch the paycheck. You'll never miss the money, and your future self will thank you. Your 50s aren't play defense. In your 50s, the game changes. You can see the finish line. Retirement is 10 to 15 years away, and protecting what you've built becomes just as important as growing it. Here's why this matters. There are 15-year stretches in stock market history where returns were negative. If you retire into one of those and you're 80% in stocks, you're in trouble. This is the decade where capital preservation moves to the front. That doesn't mean going all cash. Your money still needs to grow and outpace inflation. But you want less exposure to big swings. Aggressive. No more than 80% stocks, 20% bonds. Moderate, 70% stocks, 30% bonds. Conservative, 50-50. Start thinking seriously about what retirement actually costs. If your kids are out of college and living on their own, your expenses may actually drop. Model out what you'll need, and then add a buffer. If you think you need 2 million, aim for 2.5. It's always better to have too much than not enough. Your 60s writes, shift to withdrawal mode. This is what you've been building toward. In your 60s, the focus shifts completely. You're no longer accumulating wealth, you're living off it. If you haven't retired yet, keep contributing and grab every employer match you can. But mentally, you're now thinking about drawdown strategy. The standard approach most retirees use is the 4% rule. In year 1, you withdraw 4% of your total balance. Then every year after that, you adjust that dollar amount for inflation. Not 4% of whatever the balance is, 4% of that original withdrawal adjusted for inflation. So if you have 2 million saved, year 1 you take out $80,000. If inflation is 3%, year 2 you take out $82,400, not 4% of the new balance. Keep enough in stocks to outpace inflation, but your bond or income allocation should be significant now. Aggressive, 75% stocks, 25% bonds. Moderate, 60% stocks, 40% bonds. Conservative, 40% stocks, 60% bonds. And as you move into your 70s and 80s, that stock allocation keeps dropping, eventually down to 10 or 20% for most people. The goal is simple. Make your money last as long as you do. In conclusion, no matter what decade you're in, 3 things never change. First, keep it simple. You do not need a complex portfolio, 2 or 3 broad ETFs, an S&P 500 fund, a total market fund, maybe an international fund, is all you need to build serious wealth. Second, be consistent. Investing $500 a month every month beats trying to time the market every single time. Time in the market beats timing the market. Always. Third, don't panic. Every major crash in history has been followed by a recovery. The people who sold at the bottom are the ones who locked in losses. The people who kept buying are the ones who came out ahead. So whatever decade you're in, start now, stay consistent, and let time do the work.